Disclaimer.
AG here, your friendly Asian guy who tracks money flows. Wall Street doesn't want you noticing. Monday, January 5th, 2026 is what they're calling Black Monday. But this crash isn't about stocks falling. It's about an entire commodity vanishing, while banks holding paper contracts realize they're holding absolutely nothing. Let me show you exactly how this trap snaps shut. Monday, January 5th, 2026. Markets open in Asia after the New Year holiday, and something feels wrong. Silver futures gap up 8% in the first hour of trading. By the time New York opens, procurement managers across American industry are discovering their Q1 silver contracts from Chinese suppliers won't be fulfilled. Not delayed, canceled. Welcome to Black Monday, but this crash isn't about stocks falling. It's about an entire commodity disappearing from global markets while Wall Street's decade-long manipulation scheme implodes in real time. Here's what you need to understand about what's happening right now. December 30th, 2025, silver touched $86 per ounce, a 142% gain that outperformed tech stocks, gold, and Bitcoin combined. But that surge wasn't speculation. Industrial buyers were panic purchasing physical metal throughout 2025 because they saw this Monday coming, the day when China's export restrictions would activate, and the trap Wall Street banks spent a decade setting would finally snap shut on everyone holding paper contracts. If you bought $10,000 worth of silver on January 1st, 2025, you closed the year holding $24,200. But Monday, January 5th, 2026, is the day those returns either explode past $100 per ounce or the entire pricing mechanism breaks under the weight of industrial buyers demanding physical delivery that banks cannot provide. Here's the banking trap you need to understand before Black Monday explodes. For years, major banks sold paper silver contracts they never intended to deliver, suppressing prices while industrial demand quietly consumed stockpiles. They manipulated markets, assuming they could always settle in cash. But January 5th, 2026 is the day when industrial buyers stop accepting cash settlements and demand actual metal that doesn't exist in the quantities promised. That's when the trap snaps shut on everyone who believed paper prices reflected reality. The numbers reveal how catastrophic this becomes. 5 consecutive years of supply deficits totaling 820 million ounces. We've consumed nearly an entire year's worth of global mine production from stockpiles, according to the Silver Institute. Mine production barely grew from 784 million ounces in 2020 to 840 million in 2024, while demand exploded from 896 million to 1.24 billion ounces. We're consuming 1.24 billion ounces annually against total investable supply of 1.5 billion ounces. That's less than 15 months remaining worldwide. What's driving this consumption? Industrial demand hit 680.5 million ounces in 2024 and is projected to exceed 700 million in 2025. U.S. solar installations consumed 100 million ounces in 2024, up 35% from 2023. Tesla's new solid-state battery uses 1 kilogram of silver per vehicle, and global EV production is projected to triple by 2027. That's a 9-fold increase in automotive demand, hitting a market already in deficit for 5 years. Here's America's vulnerability heading into 2026. We produce 34 million ounces annually, but consume over 170 million, importing 80% of required silver. Roughly 60-70% comes from Chinese refineries processing 180 million ounces in 2024. U.S. refining capacity totals just 35-40 million ounces annually. We can't replace Chinese supply in time. January 1st, 2026, China activated export restrictions triggering Black Monday. Hard licensing requirements implemented on a holiday when Western markets were closed. Exporters must demonstrate 80-ton minimum production and 3 years export history, surgically eliminating hundreds of smaller refiners. China waited until U.S. manufacturers had committed to 2026 contracts, then activated restrictions. Thursday night, giving markets one panic trading day before the weekend, ensuring maximum chaos when Asian markets open Monday, January 5th. Our procurement departments woke up January 2nd, discovering Q1 deliveries won't be fulfilled. Companies manufacturing solar panels, EVs, smartphones, and military electronics scramble for supplies that don't exist. Most U.S. manufacturers maintain just 30-45 days of critical materials inventory. Those buffers are now countdown timers to Black Monday production shutdowns. Here's where the banking trap becomes visible. While paper silver pulled back after hitting $86, physical buyers in Shanghai pay $7 or $8 premiums above futures prices. Some dealers reporting $10 premiums for immediate delivery. You're watching the banking trap spring, 2 markets diverging as paper contracts collide with vanishing supply. CFTC data shows concentrated short positions exceeding annual mine production. Banks sold promises to deliver silver they never had, betting on cash settlements. But Black Monday is when industrial buyers demand delivery banks cannot provide without buying physical metal at prices far above where they sold their promises. CME Group raised margins 17% on December 26, 2025, triggering an 11% flash crash as over-leveraged speculators got forced out. London bullion market shows 1.1 billion ounces in vaults against annual demand of 1.24 billion ounces. We are consuming more than all investment holdings every year. Think about your 2026 portfolio exposure. Average S&P 500 funds have 12-15% in technology, and industrials relying on silver. Tesla, First Solar, and defense contractors like Lockheed Martin just saw input costs spike while supply vanished. The Defense Department's 2026 budget of $849.8 billion means they'll pay any price for silver, setting a floor cascading through every industrial user. Here's the banking trap snapping shut. For a decade, Wall Street manipulated silver prices through illegal spoofing. JP Morgan paid $920 million in fines in 2020. They sold paper promises while accumulating physical metal. China built refining capacity to dominate supply, then cut off 60-70% of exports when our demand hit records. Banks held short positions equivalent to over 200 million ounces in mid-2024, then closed those shorts as prices rocketed toward $86. They got out before Black Monday, leaving retail investors and manufacturers holding paper contracts promising metal that does not exist. We designated silver a critical mineral in November 2025. Too late. Even Elon Musk said about China's restrictions, this is not good. When the world's richest man who builds EVs and solar panels warns you, and when Wall Street banks suddenly close their shorts and run, you should understand what Monday, January 5th, 2026 really means. Monday, January 5th, Black Monday, represents the inflection point where Wall Street's trap destroys itself. Asian markets open with China's export licensing fully active. Procurement departments across American industry spend Monday morning discovering their Q1 deliveries won't be filled. By Monday afternoon, buyers are desperately trying to lock in Q2 and Q3 supply at any price. By Tuesday, January 6th, solar companies, EV manufacturers, and defense contractors realize they're competing for the same vanishing pool of metal. By Wednesday, January 7th, the paper futures market either breaks entirely or prices rocket toward $100 per ounce, as the disconnect between contracts and physical reality becomes impossible to sustain. The mathematical reality is unforgiving. 5 years of deficits created the powder keg. Industrial demand filled it with explosive material. Wall Street manipulation prevented new supply. China lit the fuse in January 2026 by cutting exports. When the second most conductive element becomes weaponized geopolitical leverage, prices don't gradually adjust to 100. They spike violently past that level as industrial panic buying meets a supply shortage that cannot be solved with paper contracts. Black Monday is the day the banking trap snaps shut on everyone who believed paper prices reflected physical reality. Let me show you the evidence that proves this is not speculation. It's mathematics meeting industrial reality in 2026. The data tells a story Wall Street spent a decade trying to hide, and China just exposed it for everyone to see. Industrial demand hit a record 680.5 million ounces in 2024, according to Metals Focus research. For 2025, projections show demand exceeding 700 million ounces. But here's what changes everything in 2026. Solar panel manufacturing alone is projected to consume 30% of total global supply. The Solar Energy Industries Association forecasts solar installations will require 250 million ounces annually by 2030. And that ramp is accelerating right now in early 2026 as Inflation Reduction Act projects come online. Companies took billions in government subsidies, assuming silver would remain available at $25 to $30 per ounce. Those assumptions just became catastrophically wrong. Think about the timeline converging in 2026. The IRA authorized $369 billion in climate spending, most allocated to solar and EV projects with 2026 to 2027 completion deadlines. Developers signed contracts, broke ground, and committed to delivery schedules assuming normal supply chains. January 2026 is when those projects need silver deliveries to meet their timelines, and January 2026 is precisely when China severed supply. That's not coincidence. That's strategic economic warfare timed to maximize American industrial pain. Electric vehicle production tells an even more urgent story for 2026. Traditional cars use 15-20 grams of silver. EVs require 25 to 50 grams. And next-generation solid-state batteries require up to 1 kilogram per vehicle. Bloomberg and EF projects 16.7 million EV sales in 2026, up from 13.9 million in 2025. 20% more units, each consuming 67 to 79% more silver. If 16.7 million EVs average 40 grams each, that's roughly 21.5 million ounces for automotive production in 2026. Add charging infrastructure and grid upgrades, you're looking at 50-60 million ounces from automotive alone this year. This demand is absolutely inelastic. These are signed production contracts, ordered vehicles, retooled factories. The industry cannot reduce silver consumption without scrapping billions in investment. Here's where it gets even more critical for 2026: semiconductor and electronics demand. AI data centers doubled their power consumption requirements in 2024 alone, and the computing infrastructure build-out projected for 2026 requires massive amounts of silver and server boards, cooling systems, and power management. Every AI chip, every graphics processor, every high-performance computing system depends on silver's thermal and electrical conductivity properties that have no substitutes at the required performance levels. Samsung announced in late 2025 their breakthrough 1,000-mile range EV battery scheduled for commercial production in 2026 cannot be manufactured without silver. Next-generation solid-state batteries moving to production in 2026 require up to 1 kilogram per vehicle. BYD, Volkswagen, and GM all have similar programs launching in 2026, each requiring substantially more silver than current technologies. These companies made billion-dollar commitments based on assumed silver availability. Those assumptions just evaporated. The U.S. designated silver a critical mineral in November 2025, alongside rare earths and lithium. That wasn't symbolic. It was recognition that national security depends on this metal. Defense Department analysis concluded silver shortages could impact missile guidance systems, radar arrays, satellite communications, and electronic warfare equipment. The Pentagon's 2026 budget of $849.8 billion depends significantly on uninterrupted silver supply for contracted weapon systems. Critical mineral designation in 2026 means the federal government now competes directly with private industry for supply. Defense contractors get priority allocation. Solar companies, EV producers, and tech firms face rationing. Prices can spike to levels that seemed impossible months ago because national security doesn't operate on budget constraints. Now, let's talk about the manipulation collapsing in 2026. JP Morgan paid $920 million in fines in 2020 for spoofing precious metals markets, placing fake orders to move prices, then canceling after others reacted. But that manipulation continued because profit incentives remained and enforcement was minimal. Banks held short positions equivalent to over 200 million ounces in mid-2024, roughly 24% of annual mine production. They were short a quarter of yearly supply, betting prices would stay suppressed. Bloomberg reported late 2025 that banks closed approximately 200 million ounces of shorts as prices rocketed toward $86. They got out before the trap closed completely. Here's the evidence leverage remains dangerously concentrated heading into Black Monday 2026. December 26, 2025, CME Group raised margin requirements 17%. That single margin hike triggered an 11% flash crash on December 27th as overleveraged speculators got forced to liquidate positions. What does an 11% flash crash tell you? Massive leveraged speculation still exists in paper markets, built on the assumption physical delivery will never be demanded. Now imagine what happens in January 2026 when industrial buyers demand actual metal. The margin calls won't be 17%. They'll be total liquidation, as banks realize they sold promises they cannot fulfill. CFTC reports from late December 2025 showed managed money holding net long positions of approximately 140 million ounces. Those are mostly paper contracts that will be cash settled if banks can't deliver physical metal. When industrial buyers demand delivery and there's no metal available, those longs get cash settled at suppressed prices, while physical silver trades at massive premiums. The paper market disconnects from physical reality, destroying everyone holding contracts instead of metal. Here's the smoking gun evidence for what's happening right now in early January 2026. Shanghai premiums for physical silver hit 7 to 8 per ounce above COMEX futures prices, according to Bloomberg commodity trading data. Some dealers report premiums reaching $10 to $12 per ounce for immediate delivery. When physical metal trades at a 10 to 15% premium to futures prices, you're watching price discovery break down in real time. The paper price says silver is worth $75 to $80 per ounce. The physical price says it's worth $85 to $92 per ounce. Which price is real? The one where actual metal changes hands. London bullion market data shows roughly 1.1 billion ounces in storage. Annual industrial demand alone is 700 million ounces in 2025, projected 750 million in 2026. We're consuming 68% of all investment holdings every year just for industrial applications. Those vaults are being drained, and 2026 is the year they run dry. Silver Institute's 2026 analysis projects a deficit of approximately 215 million ounces, demand exceeding supply by 215 million ounces. That deficit gets filled from existing stocks, already depleted by 820 million ounces over 5 years. CPM Group estimates 1.5 billion ounces remaining investable supply globally, with China cutting 60 to 70% of refined exports starting January 2026. That deficit could easily double to 500 million ounces annually. You're looking at 3 to 4 years of remaining supply, assuming no panic buying or strategic stockpiling. Think about corporate behavior in 2026 when supply constraints become undeniable. If you were a procurement manager with $500 million in contracted projects requiring silver delivery in Q2 2026, what do you do when your supply chain is broken? You buy 6 months or a year of forward supply at any price, because the alternative is defaulting on contracts. Multiply that panic buying across every solar company, EV manufacturer, defense contractor, and electronics producer, discovering the same shortage in January 2026. The demand surge overwhelms whatever physical supply remains. This is the proof that Black Monday is not speculation. It's the inevitable mathematical outcome of manipulation meeting geopolitical warfare in 2026. The industrial demand is real and documented. The supply deficit is real and growing. Chinese export restrictions are active right now. Banking manipulation is proven by nearly $1 billion in fines. And the trap is closing as we move through the first week of January 2026, with no escape for anyone holding paper promises instead of physical metal. Now let me show you the exact mathematical path to 100 silver and why this isn't speculation. It's physics meeting economics in Q1 2026. China's licensing system requiring 80-ton minimum production in 3 years export history eliminates hundreds of smaller refiners processing 30 tons annually. According to Reuters analysis, these collectively represented approximately 500 million ounces of annual refined supply to Western markets. Remove 500 million ounces from global supply against annual demand of 1.224 billion ounces, you're creating an immediate deficit that cannot be filled. Do the calculation. Global mine production, 840 million ounces. Industrial demand in 2026, 750 million ounces. Investment demand, 300 million ounces. That's 1.05 billion ounces total demand against 840 million supply, a 210 million ounce deficit before China's restrictions. Now remove 500 million ounces of Chinese refining capacity. You're looking at a 7 to 10 million ounce supply shortage in 2026. That's 85% of total annual mine production, simply unavailable to Western markets. Where does that deficit get filled? From above ground, stockpiles already depleted by 820 million ounces over 5 years. Thomson Reuters, Origin GFMS estimates total investable supply at 1.5 billion ounces globally. Drawing down 710 million ounces in 1 year from 1.5 billion means you're consuming nearly half of remaining global inventory in 12 months. At that depletion rate, supply runs out by mid-2027, but the crisis hits sooner. When industrial buyers realize stockpiles are draining, panic buying accelerates the timeline dramatically. The Hunt brothers comparison is critical, but this squeeze is the inverse of 1980. In 1979-1980, the Hunts tried cornering silver by accumulating long positions in futures and taking delivery. They succeeded initially. Silver spiked from 6 to 48 by January 1980, but their strategy used leveraged paper contracts. When government changed margin requirements, the corner collapsed because their control was paper manipulation regulators could break. The 2026 squeeze is opposite. This is not speculators using paper to manipulate prices higher. It is physical metal vanishing, while paper contracts promise delivery that cannot be fulfilled. The Hunts needed government inaction. The 2026 squeeze happens despite intervention because you cannot print physical silver. When Chinese refineries stop exporting and stockpiles run dry, no regulatory change creates supply that doesn't exist. This is supply-demand fundamentals meeting geopolitical warfare with no mechanism to break the squeeze without actual new supply taking years to develop. Think about force majeure on delivery contracts. Banks that sold silver futures at $75.80 could invoke force majeure and settle in cash at paper prices, even while physical silver trades at $100 and $120 in spot markets. Everyone holding paper contracts gets paid $75.80 or cash while watching actual silver change hands at massive premiums they cannot access. This creates mathematical certainty of $100 silver in Q1 2026. Industrial buyers needing actual metal cannot accept cash settlements. When banks invoke force majeure, those buyers must enter physical spot markets and pay whatever premium secures supply. Bloomberg's early January 2026 data shows Shanghai physical premiums at $10 or $12 above futures. If futures trade at $78 and physical trades at $90, what happens when procurement discovers futures won't deliver and they must buy physical? They bid prices higher until they secure needed metal. Industrial consumption forecasts 750 million ounces in 2026. If even 10% shifts from futures to physical spot purchases due to delivery failures, you're adding 75 million ounces of immediate buying pressure. Spot markets typically trade 50 or 100 million ounces monthly. Inject an additional 75 million ounces of urgent buying into monthly volumes. Prices don't increase incrementally, they gap violently higher. As buyers compete for limited supply, that's when $100 becomes the floor, not the ceiling. Here's the week-by-week timeline for January 2026. Monday, January 5th. Asian markets open with China's restrictions active. Silver futures gap up 8 to 10%. Shanghai physical premiums widen to $12.15. Tuesday, January 6th, U.S. procurement departments discover Q1 deliveries won't be fulfilled. Simultaneously, try securing Q2 and Q3 supply. Wednesday, January 7th, panic buying begins as solar companies, EV manufacturers, and defense contractors compete for shrinking supply. Physical premiums hit $20 per ounce. Friday, January 9th, disconnect becomes undeniable. COMEX futures trade 82 to 85, but physical silver for immediate delivery trades 105, 110s in OTC markets. Arbitrage breaks down because there's no physical metal available at futures prices to deliver at spot. The markets have completely separated. This is when $100 breaks decisively. Once physical crosses $100 in spot markets, media coverage begins. Silver crosses $100. Headlines: bring retail investors who ignored silver for years. That retail demand adds another 50, 100 million ounces of buying pressure on top of industrial panic buying, already overwhelming supply. Above ground investable supply totals 1.5 billion ounces. Annual industrial demand consumes 750 million ounces in 2026. Add investment demand. You are already consuming over 1 billion ounces against 1.5 billion stockpile. Now add industrial panic buying as companies secure 6 tiles or 12 months forward supply instead of normal 30, 45-day buffers. If industrial users triple inventory levels, that's an additional 500 million ounces hitting markets within weeks. You're trying to source 1.5 billion ounces demand against 1.5 billion total supply. The math doesn't work. Prices must spike to destroy demand or ration supply. Government response makes it worse. Silver designated critical mineral in November 2025 means Defense Production Act becomes relevant. Federal government can direct supply toward defense priorities. Defense contractors get guaranteed allocations while commercial manufacturers get rationed. Solar companies, EV producers, tech firms, already struggling now, face formal rationing, guaranteeing they cannot source what they need. They either shut down production or pay massive premiums in gray markets. Cascading impacts through 2026. Solar installations slow because panels cannot be manufactured. The IRA's $369 billion for clean energy cannot achieve goals without physical commodities. EV production targets get missed. GM committed to 400,000 EVs in 2026, Ford to 600,000. Impossible without silver. Stock prices collapse as investors realize production guidance was based on availability assumptions that no longer hold. The geopolitical dimension cannot be ignored. This isn't just supply demand, it's weaponized economic leverage in the US-China Cold War. China controls 60 to 70% of global silver refining, just demonstrated they can cut Western access whenever strategic interests align. The message is clear. Your green energy transition, EV revolution, technology manufacturing, all depend on commodities we can restrict. Same playbook as rare earths, but silver affects far more sectors of our economy. Combine the mathematics of supply shortage, physics of industrial demand that cannot be reduced, geopolitics of weaponized commodity control, and banking manipulation collapsing into force majeure settlements, you get a price target that's calculation, not speculation. $100 silver in Q1 2226 represents the minimum level where demand destruction begins. At $100, marginal industrial applications become uneconomical. At $100, investment buyers take profits. At $100, recycling becomes viable at scale. But here's what Americans need to understand moving through January 2026. This isn't a crisis to fear, it's reality to prepare for. If you own silver, you're holding strategic leverage in a global supply war. If your retirement account is weighted toward industrial companies dependent on silver, understand the input cost pressures they face. If you work in solar, EV, or technology manufacturing, prepare for supply disruptions that cannot be solved by paying higher prices, because the metal is unavailable in required quantities. The banking trap that snapped shut on Black Monday, January 5th, 2026, is not just about silver prices. It's about transition from a world where paper contracts controlled markets to a world where physical scarcity determines prices. Wall Street spent decades convincing everyone futures set prices and delivery didn't matter. China just proved that assumption catastrophically wrong by severing physical supply that made cash settlements viable. This is the new reality for 2026 and beyond. Commodities matter, physical supply matters, and geopolitical control of processing capacity matters more than paper contracts on exchanges. The $100 silver target is not the end of this story. It's the beginning of fundamental repricing of strategic industrial metals in a world where supply chains are weapons and paper promises cannot substitute for physical possession. The trap has snapped shut. The mathematics are unforgiving. And Black Monday 2026 marks the day Americans learned the second most conductive element on Earth became the newest weapon in economic warfare, one we are not prepared to counter because we believe paper markets reflected reality long after physical supply had vanished. If you made it this far, you're already ahead of 99% of investors who still think paper prices tell the truth. Hit that subscribe button and drop a like. It helps me keep tracking the money flows. Wall Street doesn't want exposed, and it costs you nothing but might save your portfolio everything. AG out. Stay sharp, stay informed, and remember, in 2026, the metal you can hold beats the contract you can read.